Good day everyone, I'm going to report how the market sets stock prices. First, let us see equation 5. Now let's proceed. Suppose you go to an auto auction. The cars are available for inspection before the auction begins. And you found a little Mazda Miata that you like. You test drive it in the parking lot and notice that it makes few strange noises. But you decided you would still like the car. You decide $5,000 would be a fair price that would allow you to pay some repair bills if the noises turn out to be serious. You see that the auction is ready to begin, so you go in and wait for the Miata to enter. Suppose another buyer spots the Miata. He test drives the car and recognizes that the noises are simply the result of the worn brake pads that he can fix himself at nominal cost. He decides that the car is worth $7,000. He also goes in and waits for the Miata to come up for auction. Now, who will buy the car and for how much? Suppose only the two of you are interested in the Miata. You begin the bidding at $4,000. Your competitor ups your bid at $4,500. So, you bid your top price at $5,000. He counters your bid at $5,100. Now the price is higher than what you are willing to pay, so you stop bidding. Now the car is sold to the more informed buyer at $5,100. This simple example raises a number of points. First, the price is set by the buyer who is willing to pay the highest price. The price is not necessarily the highest price the asset could fetch, but it is incrementally greater than what any other buyer is willing to pay. Second, the market price will be set by the buyer who has the best advantage of the asset. Just like in the example, the buyer who purchased the car knew that he could fix the noise easily and cheaply. As a consequence, he is willing to pay more for the car than you were. Therefore, a superior information about the asset can increase its value by reducing its risk. So when you consider buying a stock, the future cash flow has many unknowns. The buyer who has the best knowledge of these cash flows will discount them at a lower interest rate than the buyer who is very uncertain. Now, what are the values each investor would give to the stock? Applying the Gordon-Green model yields the following stock prices. You are willing to pay $16.67 for the stock. Jennifer would pay up to $22.22 and Bud would pay $28.57. The investor with the lowest perceived risk is willing to pay the most for the stock. And if there were no other traders than these three, the market price would be between $22.22 and $28.57. Thus, we can see that the players in the market bidding against one another establish the market price. And because market participants constantly receiving new information and revising their expectation, it is reasonable that the stock prices are constantly changing as well. Now let's proceed to the monetary policy and stock prices. Stock market analysts tend to hang on to every word that the chairman of the Federal Reserve utters because they know that an important determinant of stock prices is monetary policy. But how does monetary policy affect stock prices? The Gordon growth model in equation 5 explains this relationship. Monetary policy affects stock prices in two ways. First, when the Fed lowers interest rate, the return on bonds declines and investors is likely to accept a lower required rate of return on an investment in equity. The resulting decline in K sub E lowers the denominator in the Gordon growth model. That could lead to a higher value of P sub 0 and increase stock prices. Furthermore, a lowering in interest rate is likely to stimulate the economy, so the interest or the growth rate of dividends is somewhat higher. Now we are down to our final topic, the global financial crisis and stock market. The subprime financial crisis that started in August 2007 leads to one of the worst bear market in the past 50 years. The subprime financial crisis had a major negative impact in the economy, leading to the downward revision of growth rate on Gordon model.
The resulting increase in the denominator in equation 5 leads to a decline in P sub O and hence a decline in stock prices. Increased uncertainty in the US economy and a widening credit spread resulting from the subprime crisis would also raise the required return on investment in equity. A higher K sub E also leads to a higher denominator in equation 5 and a decline in P sub O and a fall in stock prices. In the early stages of the global financial crisis, the decline on growth prospects and credit spreads were moderate, and so as the Gordon model predicts, the stock market decline was also moderate. However, when the crisis entered a particularly virulent stage in October 2008, the credit spread shot through the roof, economy tanked, and as Gordon model predicts, the stock market crashed. From its peak in October 2007 to bottom in March 2009, the market lost 53% of its value. And that's all for my report. Thanks for watching and stay safe.